So in 2022, when the average portfolio was down 20%, equity portfolio, you look at the 60-40 portfolio and you say, well, I would hope that the bonds would offer, would offset that. That would be a ballast to the portfolio. As I mentioned before, bonds weren't a ballast. They exacerbated. It was pro-cyclical there. They just exacerbated the drubbing that you took in equities. So I think at this point, the AG, which is the investment grade bond index, is down 23% from its high. That includes all investment grade bonds. But as you go out along the yield curve, that drubbing could have been 60%. You look at extended duration. But that's what happens when yields are zero and the bond market is ripe for a collapse. I think and the next time we have a recession, which is 2024 on the schedule, you'll see stocks fall, but bonds will give you a ballast because they have that level of safety now. You can't rally interest rates lower from virtually zero. There's just not much room to go. But from 5%, there's a lot of room to run there. So yes, they will offer a ballast, but you got to be careful now because there'll be a truncated period of time that you can invest in duration, in my opinion. Because once the Fed starts to reliquify the money markets, then you're going to have a problem with duration. You're going to have a supply problem and you're going to have an inflation problem. So I think the long run yields are going much, much higher than they are today. But you will have that little short period of time when equity prices collapse, recession metastasizes across the globe, people rush into the dollar and U.S. Treasury market for safety, but it's not going to be as intense as it used to be. And it won't last that long because everybody knows the playbook now. What's going to happen? Everybody knows. And the U.S. is heading towards insolvency if it's not insolvent already. I think it's insolvent already. Listen, Anthony, let's just give you some facts. The U.S. is adding to so the U.S. has revenue each year. The U.S. government has revenue each year. It's about $4.7 trillion. We're adding to the national debt, which is $33.5 trillion. We're adding 45% of our revenue to the debt. So the deficits are adding to the debt every year. And the deficits equal 45% of our revenue. And the debt is 771%. The debt of our income. So if you went to a bank and you said to the bank, okay, so you're making $100,000 a year, just pick a number. I make $100,000 a year. I'm adding $45,000 to my debt pile every year, and my debt is $771,000. The bank would throw you out right on your butt. That you want a loan? You want me to give you a loan? And you are insolvent. You have an untenable amount of debt compared to your revenue, and you have you're adding to that debt equal to almost half of your income every year. You're done. And if they were so stupid to give you a loan, it would be a loan that was 50% interest rate because the risk is too great. That's where we are as a country. And that's in the good time. We're not now officially in a war any longer, and we are in peacetime, and we are in a time of full employment, supposedly, and with 5% GDP growth. Just imagine how bad those numbers I just gave you are going to be in the recession. And the recessions are coming. They haven't been canceled.